Joining us now to talk about the impact of a shutdown, Mark Zandi, Moody's Analytics chief economist. For all these reasons, Mark, are investors right to brush off the threat of a shutdown and what that might do economically?
Well, Sarah, I mean, if the shutdown is a week or two, and that's probably the most likely scenario, and that's probably what investors think is going to happen, appropriately so, then, from a macroeconomic perspective, a market perspective, no big deal. I mean, obviously, it's a big deal for the government employees that are furloughed or fired, but from a broader economic perspective, not so much.
What about this idea of a data blackout and how that would leave a Fed that is very much data dependent in the dark?
Yeah, well, it's not great. And this is a particularly bad time because we're at an inflection point in the labor market. The job market hasn't created any jobs over the past few months. We lost jobs back in June, and that's before revision. So, pretty inopportune time. And of course, the Fed's got to make a decision about interest rates at the end of October again. So not great. But, again, if it's a week, 2 weeks, any longer than that, then it becomes a real problem. And then I think investors will take notice.
What is your expectation about what the next jobs report will show after we've seen the signs of weakness that the Fed responded to?
Yeah, I expect kind of a flat labor market, no job growth. There's no hiring. Businesses just aren't hiring. They pull back on hours. They cut back on temp jobs. Fortunately, they're not laying off. Unemployment insurance claims remain very low and not consistent with any pickup in layoffs. And that's really the firewall between an economy that's what it is today and a recession. So that's fortunate. But I expect that to continue. I don't see businesses changing that anytime soon. So at best, I expect a flat job market. And when we get all the data in, all the revisions come in, I think it'll show that at this point in time, we've been losing, a fair amount of jobs.
I believe, Mark, you've been pretty negative on the impact that tariffs would have on the economy. So I guess I'm wondering if you're pleasantly surprised that second quarter GDP growth was 3.8%, that spending in August, personal spending was 0.6%, a lot better than expected, and that inflation hasn't surged past 3%.
Yeah, I mean, the revisions to GDP were good, Sarah. I was surprised by the consumer, the strength of the consumer. I do think, though, that goes to the bounce in the stock market and the wealth effects. I think all of the spending is coming from the well-to-do, high-income, high-net-worth households that are seeing their stock portfolios are up and they feel a lot better and they're out spending. You can see in the saving rates. The saving rate back in April when the tariffs really kicked into gear was almost a percentage point higher than it is today. And so that decline in saving represents, I think, high-income consumers just becoming more aggressive. So, yeah, I'll take it. I think it's a reason why, we should be able to navigate through without recession. But I'll have to say, when you're not creating any jobs and you're actually losing jobs, that's just not a very comfortable place to be, and I don't think that's sustainable. So, we're not through this yet. The tariff effects are still playing through. The effects of the immigration policy is still playing through. So, yeah, I'll take it, but I don't think the coast is clear by any stretch.
We've seen some sort of disturbing data on average FICO scores. Obviously, auto financing had some collapses in auto subprime. Can we deal with all of that? And I mean, is the overall spending sturdy enough to weather a real source of pain out of the lower cohort?
Yeah, Carl, here's an amazing statistic. It's something we've constructed based on Federal Reserve data. The folks in the top 10% of the income distribution, just soak that in for a second, top 10%, they make over, let's say, $275,000, $300K a year. Not in New York, but nationwide, that's the number. They account for almost half of all of the spending done in the economy. So, the folks in the bottom third of the distribution, the bottom two-thirds of the distribution, they could be struggling, and they are. You make a great point with regard to the credit scores and, what's going on with auto loans and student loans, that kind of thing. But the economy can move forward, and that's exactly what's happening if the high end, if the well-to-do are doing their thing, and they are. But it does bring up a point that the economy is very vulnerable. If the stock market does turn south for whatever reason, if people start seeing red on their screen and not green on their screen, and the saving rate goes up, not down, that in the current context with no job growth, that's recession.
All right, Mark, thanks for joining us with your take
anytime.
on what we're seeing. Appreciate it. Mark Zandi.